Hello, Maverick traders. Welcome out to your FOMC preview as we get ready for the Fed to embark on interest rate cuts. Always a fun time. Let's jump into it. So we'll start with a little bit of background of what's the data coming in. So this morning we got retail sales here in the US. You can see a better than expected number. We came in slightly positive on retail sales. The expectation was for a minus 0.2% retail sales number. So beat expectations. Does this matter really in the grand scheme of things? Probably not, but people are looking at these data points and saying, is this going to push the Fed one way or the other? The economy is still chugging along, and markets anticipate that the Fed's going to start by cutting rates by 25 basis points. That's the expectation, but it still is a little bit up in the air. It's a little bit strange because usually as you come into Fed meetings, they give you a pretty good sense of what they're going to do. It could be 25, could be 50. Importantly, this is embarking on interest rate cuts. Now, remember, we have the statement that comes out, but then a half hour later, we have the press conference. And what you often see with these is a directional move, and then that can completely reverse on something that Powell says during the press conference, something that changes market's anticipation one way or the other. If we come down here and look at the bank rates, you can see our central bank rate here in the US at 5.5, the highest of the major currencies. If we go to the graph, this is really a telling story, and this I think is most important. When you look at where we're at, we're just starting an interest rate cut. Now notice how these go on trends. They hike and pause and hike and pause and hike and pause, but they're in an interest rate hiking cycle. And then there's a bigger period of pause, and then they embark on a cutting cycle, and they pause and they cut, and they pause and they cut, and they pause and they cut. But see how there's more and more cuts coming, and then a big pause, and then they embark on an interest rate hiking cycle, and they hike and they pause, and they hike and they pause, and on we go. We're just starting the interest rate cut. So will there be some pauses and cuts and pauses and cuts and pauses and cuts? Yes, and we're going to go down here probably going into the fours very quickly, whether they cut by 50 or 25 here. There's more coming. And then we'll probably get into the threes and so on. So as market participants, we have to understand that this is not just one interest rate cut. This is embarking on really multiple cuts that are coming down the pike. And so already you're seeing asset prices adjust and reflect this dynamic that we are going into that cycle. So a few charts to look at. We're going to start with 7 to 10 year treasury bonds. Bond prices and yields move in opposite directions. Look at what bond prices have been doing the last few months. This is a huge move in the bond market. This much upside in the bond price, if we were to flip that around, it's an inverse relationship. Yields have come down substantially. This is treasuries. So interest rates have already adjusted. The bond market is already front running the Fed in major dynamic here. As you get a sense that rate cuts are coming, they have to price in. Remember, the markets price in the future, not the current. So do you think that all of this upside in the bond market and relative downside, right? Have yields been collapsing because the Fed's about to cut by 25 or 50? No, the yields have been collapsing because they know that the Fed is about to embark on multiple rate cuts over the process of many months. Gold, silver, you see these trends that are strongly to the upside. Now you say, well, why would precious metals be going up? How are they impacted? Well, remember that one of the big difficulties of putting your money in gold or silver is it's just a shiny metal. There's no income. It pays no interest or anything like that. And so it's always a competitive, if I own gold, I'm missing out on the income side. Whereas if I'm in a bond, at least they're paying me some money for being in that bond. Well, as interest rates come down, the relative attractiveness becomes better because now all of a sudden we have a situation where we're not as worried about owning gold if interest rates are going to go lower because we're not missing out on as much. When you can be in a treasury that's paying you 5%, you have to think that gold is going to go up by more than 5% for the year. You have to think that gold is going to increase by 10 or 15 to have that relative value. Again, if interest rates are down at 1% or something where it's just you're not missing out on anything, then you can feel good about being in gold and these assets. Of course, the markets have been anticipating interest rate cuts. I don't think it's necessarily all clear. Historically speaking, generally when the Fed is cutting, it's usually because there's economic slowdowns and a rise in the unemployment rate, and usually when people lose their jobs, stocks suffer and so on. So I don't think this is as clear a picture, but certainly some of the relative strength is that hope that they're going to cut. And then if we dig a little bit further, we can go into US dollar. And as you look at the dollar by itself, notice the US dollar and its directional move. The dollar has been on a steep decline for many months, and believe you me, they are pricing in these interest rate cuts that are coming. So the US dollar is already front running and pricing in that dynamic. If we were to match the US dollar up versus all of our other major currencies, pretty much the same dynamic. We broke out of the channel and we've been pricing in lower and lower prices because, again, as it's that relationship where higher yielding currencies tend to be a little bit stronger. As you start to cut interest rates, that's usually weaker for your currency, and US dollar is already pricing that in and really needs to price in not just one rate cut but many, like we talked about. So where do we find ourselves in the dollar? Well, this is the daily chart. If we come into the 12-hour and look at it a little closer, you're in a basing pattern. If you come into the 4-hour and look at it a little bit closer, you can see that dynamic. Ultimately, I worry that the US dollar is in a bit of a bearish scenario here. You've got support down at the bottom, but you can see big bounce followed by a smaller bounce, and my instinct would be to look to short US dollar versus other currency pairs. So if we were to just look at US dollar, the only thing it's better than is maybe the Canadian dollar. So if I was to say, well, if you want to buy US dollar, you probably want to do it against CAD. You can see basing sideways. This is dollar CAD pair. If you want to go long the US dollar on the Fed, I think this is your chart. This is the resistance zone, consolidation, could break out to the upside. But if you want to get short the US dollar, which is my leaning, certainly has been the dominant trend, Euro USD, so look at how much stronger the euro is than the US dollar. So you would buy Euro USD or you would buy Pound USD. Now we're seeing a sharp give back in pound preceding the Fed meeting coming out in a couple hours, but ultimately those have been a little bit better, a little bit stronger currencies. Aussie has been pretty darn good as well. There's more things to buy against the US dollar than to short. So I think your basket of potential short US dollar trades are probably Euro, Pound, and Aussie. And if you foresee the US dollar is going to have a nice upward push or it starts to break that way, I think dollar CAD is your pair. So that's really the main currency I would be interested in buying US dollar against would be the Canadian dollar. So those are your potential trades. You want to get long US dollar, buy dollar CAD. If you want to get short the US dollar, look at your euro, your pound, your Aussie as potential plays. Hope you enjoyed this preview. Have a great time trading the Fed meeting, and remember that 30-minute later press conference that comes out, be prepared for that. Have a great one. We'll see you next time.